everyone, and happy June. Hard to believe it is already June, but the sun outside will tell you that it most certainly is. Um, I am coming today after a bit of a multi-week hiatus. We had some unfortunate news in our family. We lost a very important person to everyone in our family, so we have been taking our time to handle that and work through that together as a family. So I appreciate your patience and um, you know allowing my family and I to grieve our loss. But with that being said, I'm back in the saddle, let's say, and this week is a heck of a week to really kind of zone in. I actually was originally going to record this past Friday. Today is June 9th. 2026. This was originally meant to be recorded on June 5th because if you were paying any attention to just markets in general and kind of the overall uh, sentiment, vibe, whatever it might be of the market, you know that Friday was a pretty boisterous day, pretty rocky day. The worst day of 2026. A lot are quick to highlight that. Um, Surprisingly, Friday was far more organized and, let's say, kind of not to say calculated, but it doesn't surprise me at all that we had Friday occur the way that it did. Doesn't make it any more fun, but it doesn't make it a surprise and it doesn't make it a shock. So that's a good thing. But the reality is that right now, and the reason I'm really doing this video now is I have to address an elephant in the room. I have to talk about something, and this could very easily turn into a kind of a clickbait thing. I'm not meaning it that way. But my goodness, everybody and their mother wants to talk about it. Um, we have a big week this week. Just so happens we have a big week this week that's going to transition into another week next week that will be interesting, to put it lightly. But the real kind of heart and soul of things today is, or this week rather, is yes, the SpaceX IPO. I have received a number of questions about this, and I thought it would be appropriate to take a few minutes to really talk about not only the SpaceX IPO, some of the things that are happening in the market, because inevitably, if you are browsing the internet or a social media site or something else, anytime there's a big item like this, everybody's an expert, right? That's part of our plague of certainty that we're living amidst. Everybody's absolutely sure of of everything, it seems. But you get these people who, I love the old saying that it's like I've heard it in different renditions, but it's something to the effect of, we use the word expert because charlatan's too hard to spell. Um, and in a lot of ways, that is so common right now. There are these people who, they're charlatans. And I've been sent numerous articles from clients and friends, prospective clients. What are your thoughts on this? What do you think about that? I always welcome those. I encourage you. If you come across something, then you're finding yourself, let's say, emotionally charged, or even if you're just intellectually stimulated by an idea, you want to send it my way. I'm more than happy to share my perspective. I will warn you, I am overly analytical to a degree that I will look at every side of it and I will try to punch holes. Because ultimately, as we see with anything that is clickbait worthy or newsworthy, as the IPO of SpaceX slash XAI slash Starlink slash whatever this big amalgamous blob is, it's ripe for clickbaity news articles, and journalists love that kind of stuff. So, they're going out and they're interviewing, let's say, experts. Again, we'll use air quotes on that one. And they're getting plenty of little snippets and tidbits, and here's what you need to look for, and here's how this is a stunt by Elon Musk to throw the little guy under the bus, and all this other stuff. Um, but we need to kind of suss out sort of what's real, what's fake. And I'm gonna share with you here sort of the way that I'm looking at this and also then share why, with Carriage House planning, with our investment strategy, with our discipline, why IPOs really are a lot more of background noise than they are something that we really focus or pay attention to. Not to say that there's not something there, but bear with me as I kind of work through this. So, first and foremost, let's just talk about the general premise of IPOs in our modern day. The idea of an initial public offering or an IPO is not a new one. Most people who have invested in anything are at least generically familiar with it. IPOs are a way for a private company to become a publicly listed company or publicly owned company. Now, I'm going to oversimplify this on purpose because we overcomplicate everything in our modern world, and we shouldn't. We need to get back to first principles on everything, really. Because once you do, and once you see the simplicity of things, you then start to better understand what is perceived to be the complexity of things. So, with an IPO, with an initial public offering, the general premise is it's to raise capital. So you would say, okay, and there's other reasons, but generally speaking, that is why you would go to the public markets. You say, okay, look, I've got this company, this idea, I've been building it, or it's a new idea, whatever the idea, whatever the premise is. Um, we want to allow other people to come in and become owners with us, whoever us is, right? Whoever's kind of the core founding parties. Um, we want to let the public own the company and participate in the growth of the company and participate in the theoretical future success of the company. And in return, right, we're willing to give up some ownership of the company. That's one area that's becoming more and more gray as time goes on. Um, but that is the initial premise of the IPO. And in turn, their capital, their money that they're investing in the company can be used to grow the company or to pursue the next endeavor that the company has. Now, this would be in opposition to or in complement with something like a bond issuance or borrowing money, because ultimately that's what a bond is you're just borrowing money. So the idea of borrowing money is you have to pay it back. And whoever's lending you the money doesn't get ownership of the company, right? So most little startup companies are probably going to borrow money, right? That's how they try to, get where they're going if they don't have the capital already themselves. Um, with an IPO though, and this is where I mentioned a moment ago, kind of the gray area. Again, historically speaking, you IPO and then all of a sudden as an owner, you have to relinquish traditionally a pretty good bit of control of the company. And you potentially risk getting pushed out even fairly early on. While most shareholders wouldn't want to necessarily do that, there have been many, many cases where a company goes public and either an activist investor or a green mailer, meaning somebody who's doing like a pseudo blackmail strategy, but to own your company, or a hostile takeover, something like that happens where they basically come in and they either try to buy up a majority share or they, you know, will try to position members on the board to usurp or subvert the CEO or put a new CEO in, whatever it might be. But really, after I use Google as kind of my benchmark, my line in the sand. It's not to say they are the first ones. They very well may be. I know that they were one of the first major modern day tech companies to use the Dutch auction model for their initial offering. But if I'm not mistaken, Google was the first to do the multi-share class IPO. Could be wrong on that though. That's from my market history. I need to probably brush up on it. Um, but one of the big talking points of this particular IPO, not only its size, yes, it very well may be the largest IPO in history, blah, 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 blah. Okay, that doesn't say much when when you're inflating a marketplace over time. But then some will argue inflation adjusted, it's the largest. Okay, that's fine too. That's fine too. Whatever. But the point being is it is going to be an offering that has two different share classes, at least. That could also expand. We could go beyond that. But the premise behind the way that this particular IPO is being issued is not uncommon, even though the news articles are going to tell you this is like this whole new thing. This is not new. Really, since the Silicon Valley tech startup, you know, series funding through private equity and then going public model has kind of grown into its maturity. The idea of having these two share classes has become more and more prominent. And the reason being is because, generally speaking, these tech startups are not a manufacturing company. They are not a producer of a good or a product. A lot of them are ideas. They're ethereal. They are intangible in a lot of ways. Um, and because of that, there is an inherent need, per se, at least from the founder's point of view, to ensure that they maintain control of the company because they have a vision, and that vision cannot be fulfilled if it's handed to someone else. So while the social media expert is going to sit there and tell you this is really bad for shareholders because Elon Musk is just going to make all this money and everybody else is going to get caught, holding the bag. Um, I don't necessarily say that that's not true. It could be. I'm not going to argue that. I'm going to say though is there is another side to that story, which is investors very well may want to ensure as an investor, right? If you're buying into this company, do you know anything about SpaceX? Do you know anything about XAI? Do you know anything about Starlink? Do you know, right? So as an investor, you're saying, look, I don't know how to do better. But I don't want someone else coming in saying that they know better. I want Elon Musk to run this company, control it, and not be usurped or subverted in any way, shape, or form. Right. So that's the counter argument. So let's get that off the table. If this whole like big billionaire could be the first trillionaire trying to take the money out of the pockets of the average man, because it's 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 not off the table, but it can easily be argued the other way. Okay, so point number two around this particular IPO is this idea of fast tracking to indexes. Now, this I think is actually something that we do need to think about when it comes to our modern day investing for the average individual. Indexes have become far more opportune or opportunistic or whatever. They are efficient, generally speaking. They and an index meaning a passive bundle of stocks that meet a certain criteria but do not have an expert or a investor or a manager making selective decisions of what is bought and what is sold. It's a rules-based system. And for that reason, it's a low-cost investment vehicle. So think of the S&P 500 index or the Nasdaq 100 index or whatever else. They get wrapped up into ETFs usually, although they can be wrapped up into other vehicles like a mutual fund or exchange traded note. Or you're seeing a lot of these you know ultra leveraged tools, which that's a whole nother can of worms. But the idea of fast tracking a brand new company into an index is kind of an interesting philosophy or theory. And the idea being is most of these indexes are cap weighted, meaning the largest companies get the largest share. And then it's, well, when do we actually get a market going through price discovery versus an IPO price discovery, which is a select group of underwriting banks that are underwriting the initial offering, who have done, yes, some vetting and some analyst work. They don't want to be caught holding the bag, but they're valuing the company. But then you have Elon Musk, who's simultaneously telling you this is what I think the company's probably worth. And then you get, of course, the mouth breathers, that go, well, it's not fair that he's trying to manipulate the market. Look, every market participant's been trying to manipulate the market to their favor. Every hedge fund manager goes on CNBC and tells you what they think are the best stocks because they own those stocks. Like, don't sit there and bemoan, oh, big billionaire is telling me his company's worth more. You don't have to buy it. Nobody's making you buy it. But their argument is, but if they're in the index, if they're fast tracked into the index, they are making me buy it because I'm a passive index investor. Or I'm in a pension, right? My well-being. I'm a teacher in California, so the CalPERS or the California State Pension or the New York State Pension, they inherently own these indexes, and now this company is going to come in and it's going to have this disproportionately large share. So I'm forced to own it, and it's not fair that he's talking up the market, and then you're going to get these insiders that sell it, which I'll talk about in just a second because that is an important point. But is that an issue? Eh, yeah, kind of. Okay. The issue though is not with these companies going public, and we've got to get over this. Everybody wants to blame, 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 blame. Now, I tend to adhere far more to the Stoic point of view of, extreme ownership, and that's my belief system. If it's not yours, that's fine. I'm not going to tell you you need to believe that, but I am of the mind, being a proponent of the individual, a believer in and a major supporter that the individual rights are the most important to be not only protected and saved, but also to be exhibited and fulfilled. And for that reason, if you have a problem with your pension, you need to go talk to the pension managers and you need to make sure that they're hiring better managers of the pension who don't just go and buy a passive index, who have some kind of vetting process for investing. Okay. You need to go talk to your 401k or your company who is offering you a 401k and tell them, I want better investment choices in our 401k. Right? You have that right. You have that ability. Now, whether they listen to you or not, different story. But at the same time, that also goes to, if you don't like that, no one's telling you you have to work there. Go get a different job. It's easy to say, harder to do, and I fully recognize that. I'm not one of those people who's just like, just go get a new job. They're everywhere. Like it's like an apple, go pick it from the tree. No, I'm not saying that. What I am saying though is, don't get on the bandwagon of this is some big setup to screw you over in a way. This could create a tremendous amount of opportunity in the market. Could, but it might not. I don't care either way. Now, that's going to take me to my next point, and then I'm going to come back and talk about the insider details about this SpaceX IPO because it does matter. But before I do, let me talk real quick about why Carriage House Planning and our investment strategy and our investment discipline, why we don't really care about IPOs. We care about them because they're going to move markets. They're naturally going to move markets. But again, that's background noise. Everything moves markets. Trump tweeting moves markets intraday. Um, you know, wars, oil draws, China just drew down on their strategic reserve, right? Those all move markets. Um, Trump meeting with Xi Jinping. Wow, that was hard for me to say today. Xi Jinping, and then watching Taiwan and South Korea basically go parabolic in the markets that moved markets. Okay. All kinds of things move markets. Don't become myopic where you say only this thing's move. No, that's what markets are. They're shared ideas interfacing with one another and competing for who has the better idea, whether they're right or wrong to be seen. But that's what it is. It's buyers and sellers disagreeing and agreeing. But for that reason, when it comes to an IPO, what you don't have is you don't have a market. So I'm going to use an equivalent of residential home sales. Okay. Because I oftentimes will look, especially when I'm talking to clients about buying and selling homes, my home's worth blank. And I say, you don't know that. You do not know that. You think it's appropriate that your house is worth this. But the only way that a single house is worth what you say it is you get a single buyer or a fund or whatever that agrees that it's the right price because it's one unit that is unique. Your home is inherently unique, even if just by location. Let's say you live in one of these, centrally planned neighborhoods. Every house looks the same. They're cookie cutter. Fine. Every house the same. However, your location is unique. Okay. But there's something about your house always, always, always that makes it different than everybody else's. So for that reason, it is unique. Secondly, there can only be one buyer, whether it's again, let's say a fund or like a group of people, but the buy and sell has to match and they have to agree. That is what price your house is. So much like a traditional, let's say, bazaar or a market, let's say craftspeople at a farmer's market. Okay. Weekend farmers market. Crafts people come together. They make these unique, cool little crafts. Each one's unique. Each one's special. It has their own thumbprint on it. Whatever it is, they think it's worth whatever. The market might disagree. Maybe they barter. Maybe they, go back and forth with a buyer. The buyer says this is my highest number. The seller says this is my lowest number. They don't match. No sale is made. Okay, you get the picture that I'm painting here. Well, when it comes to IPOs, in a way, you kind of have that. Yes, there are a lot of shares of identical things. So that is where it differentiates. However, these banks all come together. They do their what they call the due diligence process. They go through. There's all these different. They have Form S. I'm like totally spacing right now. But they have their disclosures. They have their financials that come out on the table. Okay, SpaceX financials kind of kind of messy. I'll be honest. They're kind of messy. I would expect them to be, though. Point being, though, is these banks all kind of decide on what the initial offering price is going to be. All right. And then they get allocations because they're underwriting this. So they agreed to pay for it. Okay. For the shares that are going to be the float or the publicly traded shares. Now, there's also the shares that are going to be held by the insiders or the initial investors who are investing in the private markets that already own shares of this, that invested in this. There's plenty of those. Consequently, or interestingly, about this particular deal is from what I've ascertained, only 5% of the total shares are going to be in the public float, meaning are going to be issued to the public. And that's part of the structuring of the two different share classes and the fact that Elon Musk effectively retains complete control over this company and will inevitably into perpetuity. And then beyond that, I haven't even gone into the details on it. But as we talk generically about why we don't participate in IPOs, let's say that those underwriting banks, those investment banks, they create these shares, they give allocations specifically to their pools of investors. Those investors, a lot of times, are literally looking to buy it at whatever the initial price is and then immediately sell it because they presume that once it comes to the market, there will be this other group of people who are, clamoring with their hands in the air, give me some, give me some, give me some, and they'll buy it at a higher price. And then there's, right, a gain to be made. Others, of course, in that initial pool are saying, I actually want to be a long-term investor in this. I want to own this. And okay, so I get in at the initial price. It goes up, down, doesn't matter. I'm looking at this as a long-term investment. That's fine too. Okay. But ultimately, you have a very small select group of, yes, investment bankers that are setting the starting price. Now, is that what that company's worth? I don't know. It might be based on book value, right? Show me all your assets. Show me how much metal you got in a metal facility. So show how much in the accounts receivable. How much in the case of or SpaceX, like how much revenue are you getting from Starlink and your rocket ship launches, blah 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 blah. Yeah, I could sit there and be like, this is what this company is worth. But worth is unique. Let's use again the house argument. It's your house. You put love and affection into it, and you also I'll even use myself as an example. The home that we left in Florida when we moved our family to the bluegrass state. I had built because you all know me. I love woodworking and I love building, but I had built this really really special custom bed for my daughter when she was very little, and it was this really cool. It was a house. It was a full house, and it had an upstairs, and it had a bed in the downstairs, and it had a front porch, and it had a little secret library room where like it was like a bookshelf, and you open it, and she could go into this little secret like reading cubby, and it was very special to me. But for it to be special to anybody, it would have to be like either a grandparent that has a granddaughter, or it'd have to be a family that had a little girl, right? That's a unique buyer to agree that this is worth what I think it is because look at this special thing, right? I think it's worth more. Now, whether it is or isn't, okay, whole different conversation. But the point is that that's where valuation comes from in this little tight, kind of constrained market. But then once something comes to a marketplace where Not only are those shares identical, again, unlike a house, unlike a piece of pottery or whatever it might be, every share is the same. The ones that go to the public, okay? And those shares representing ownership in this company now come to a marketplace. The IPO value is, let's say, let's use easy numbers. Say it starts at $10. Fine. Okay. $10. Immediately, all these people are like, I want some, I want some. I'm willing to pay 15. I'm willing to pay 18. I'm willing to pay 20, 50, whatever. Okay, price goes up. Then they get them. Fine. The people that are willing to sell sold. The people that want to hold hold. Now they say, wow, look at me. I've already got $40 of gain on this investment. What a great investment. See, it's going to continue. But then something unique will happen, almost inevitably. It's not always, but almost inevitably. The people that were buying it, all of a sudden now we have earnings calls. We have just the performance of the stock. We have need, right? Oh, I got in a car accident. I just bought these shares. Dang on it. Now I need to sell them because I got to go pay to repair my car. It could be a billion, million, trillion, gazillion. I don't care, different reasons why. But all these people now all of a sudden they go, I need to sell. I just bought these, but now I can't hold them long term. I need to sell them. Okay, fine. Well, now there's this other wave of people in the market that are like, no, I don't think it's worth $50. I've seen their financials. I don't think it's worth that. I don't want it that bad. I'll pay you 40 for it. Well, how bad did the person that has it at 50 want it? How bad do they need it? They might take 40. Okay. Now all of a sudden you're getting what's called price discovery. And that's where a market is coming. A lot of people looking at the exact same thing and determining this is what I think it's worth. This is what I think it's worth. This is what I think it's worth. As technical investors that also look at fundamentals, right? Carriage House planning, we need to see real market price discovery before we have any confidence in an issue. So for that reason, we don't participate in IPOs. I don't care about them. Now, are they going to sway the market? Are we going to see capital vacuums occur? Friday very well may have been partially a capital vacuum where individuals, institutions, whoever it might be, we're like, hey, look, we're doing good enough. Next week might be volatile. Let's go ahead and raise some capital out of some existing positions and let's have it ready because we want to go and buy SpaceX. That could have happened. I don't know. We don't know, but that's okay. All right. Now, some might come out and admit it, and that's fine. I don't. Point being, though, is the IPO itself will adjust markets, it'll move markets. But we don't want to participate until we actually can see what the market really believes about the investment. And until we do, we can watch it from the sidelines and accept the fact that it's going to create background noise. And that background noise needs to be monitored, but we're not going to act on it. Now, let me kind of come back to something I put a pin in a minute ago, which is one of the other unique things about this specific IPO. And this isn't exclusive to this deal, but it is for the size of it, the significance of it. This one matters. And that is this particular deal allows for insiders. So those who have owned the shares pre-investment, right? Private market investors, they're it's generally speaking, there's somewhere around a 50 to 150 day lockup period after an IPO where insiders can't sell to prevent jump and ship. Now, in this deal, they can, from what I understand, the insiders can actually sell up to 20% of their position after the first earnings, which is in June. So we get an IPO on Friday. It's going to happen in the next 3 weeks. So there is a good argument to be made there that that could be a bit of a bag, a bag toss handoff situation where the little investor gets stuck holding the bag, the big investor jumps out. Up to 20% of their position. So are they going to be incentivized from a praxeological point of view to crater the stock or to get out thinking it's going to crater? If they think it's going to crater, right? Selling 20%, yeah, it'll help. but they're still going to be holding 80% of whatever their position is. So it's like a yes and no. Yeah, but that's also another reason why you don't want to jump in on the IPO, because the inherent volatilities, the ups and downs going into this are going to be extreme. Okay, that's the IPO story. I'll show you a couple IPOs and charts in just a second, but to keep this video as short as I can, I want to address two other quick items. One of the other things that's being talked about a lot is and it's getting completely misunderstood, mischaracterized, but it is the PTD rule elimination. Now, um, PTD rule is the pattern, or PDT, pattern day trader. Excuse me. This was just starting. I think it was yesterday, actually, the 8th. I think is when it technically went into effect. And if I'm not mistaken, brokerages have like, I think, say maybe 5 months, 6 months, could be more than that, to officially enact the changes in their systems. But the pattern day trader rule came out post dot-com bubble in the early 2000s. And it was this rather clunky rule that suggested that if you're in a margin account, so that's one of the first things. So, in other words, you're borrowing, so you have your money in an account and then you're borrowing to do additional trades in excess of whatever capital you have on the table. If you're in a margin account and you make 4 trades, I think within, if I recall correctly, it was within 3-day period um, of the same position, you're labeled as a pattern day trader in this in a brokerage's system, and as such, you're then required to hold $25,000 of capital in the account. Um, and this was a, let's make sure that these, like, somebody doesn't come into an account with like $1,000, lever it up to, let's say, $2,000. They're trading like crazy, and they could basically be caught with their, we colloquially refer to it as getting caught with your pants down, where they basically go bankrupt because they actually can't afford to be doing this, because there was so much of that nonsense happening in the dot-com bubble. The problem with it is, though, if you really think about where we were in 2000, 2002, in that era, in that period, with computers and with computer settlement and with everything going on, and there was other reasons behind it, but the rules started to become rather clunky in today's world. Um, as such, it's basically, if I understand correctly, it's basically you now have to have about $2,000 in the account. Okay, this is now being rolled out or presented as, oh, look, the SEC is now also making it so that the little guy can really get screwed so that the billionaires can get more billionary. Careful with that, okay? And that's not to defend it. I think the pattern day trader rule, look, again, I'm an individualist. If you're foolish enough to go try and do this, and you think that you're better than what decades and even centuries of traders have proven, which is day trading, it's just gambling. You cannot actually measurably win with a consistent level of winning over an extended period of time. It's not to say you can't get hot streaks and win. That's not what I'm saying. What I'm saying is no one has ever proven consistency over time with a winning percentage using day trading strategies, because markets are markets and that's what makes them awesome. Okay. If you're foolish enough to do it, I'm of the belief there shouldn't be any rules. You want to go and do that? Like, but you need to pay the consequences if you're going to be that foolish or that desperate or that whatever. Okay. But others disagree with me that, um, you know, uh, maybe I'm a bit uncouth for saying it this way, but we have a bad habit of regulators protecting stupidity. I think stupidity should be as painful as possible. It prevents you from being stupid again in the future. Um, I, I I know that I'm probably a bit of a outcast in that belief system. A lot of people, especially politicians, think that they can justify their own existence by creating regulations to protect those who don't understand what they're doing. Now, there's predatory events that occur. And I would argue that, yeah, to some degree, some of these brokerages that are like, hey, little guy, we'll extend you $5,000 a margin. Come and trade on our platform. And it's like, oh, I've got $3,000, like, and you'll give me $5,000 to trade with. Cool. The problem though is like you lose, what is that, like 15, 18% on your portfolio, and all of a sudden you get a margin call. You got to come up with money, bud. Um, you got to see, like, there are plenty of companies out there that will predatorily, they'll prey on investors, try to get them to come in. Yeah, that sucks. I hate that. I think that they're garbage. They're dirt bags. Do we need regulations though? Yeah. Okay. Let's leave that conversation out. What I think is worth having the conversation around though is, was this some kind of strategic way of positioning the market so that the little guy can get screwed over more with SpaceX or any other stock for that matter? Is this some would suggest this is a symptom of we're in a late stage of a cycle, and they're trying to pump the little retail client and give them as much flexibility to buy everything off of those big successful institutional traders and hedge funds and billionaires and da 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 da. That argument starts to lose steam pretty quick in my eyes. I don't see that being actually the impetus behind this. I do see the pattern day trader rule elimination as being one that is, we are now living in a world where we have the tokenization of a lot of things. We have this whole other market, let's call it the crypto, blockchain, whatever. It's trading 24/7. It's gaining, capital. So it's overall, capitalization is larger. The, let's call them legacy markets, or the equity and bond markets, they're probably, if I'm looking at like what's the most logical baseline, fundamental, foundational argument as to why they would eliminate this or kind of get rid of this clunky rule, is they're looking at it going, we like can't compete, right? It's a market of competition. We want more interest coming into the equity markets. That's what our listing, partners, the companies that are listed on our indexes or our stock exchanges, they want to make sure capital is interested here. The SEC is getting, lobbied by them. That's probably what's going on. It's not like the nefarious. I really, being the guy who will sit there and tell you the Federal Reserve is the, creature from Jekyll Island, and they actually are a banking cartel of people that sat in a room together and plotted to do really bad things. That's real. This one, not so much. So we can go ahead and kind of use dry erase board here, and let's erase that. With that though, but I'm going to use that as a quick segue for the last point. Next week, I mentioned that this week's a big week. Next week's also a big week. What's going on next week? Next week we have the first Federal Reserve rate decision meeting with the new Fed chair. So this is a big deal. Friday, when we had that big market sell-off for that very volatile day. And then actually, as I'm watching numbers today, markets are not pumped today. They're not happy today. After a bit of perhaps it was a dead cat bounce yesterday, perhaps not. I would argue long term, no. Short term, it's possible, yeah. But the Friday thing that I think is most interesting is that all of a sudden the news cycle started running hard with, we're going to get a rate hike. We're going to get a rate hike. We just went from rate cut to rate hike. Now, if you watched my last video, if you watched my quarterly market breakdown along with the portfolio changes, you will know that I am of the camp that rate cuts percentage which is most likely to occur, a cut is highly, highly likely respective to a rate hike. I do not see a rate hike happening until at least Q4, probably later this year, if we're going to get one. So I do not see a rate hike next week. The reason that news cycle came up was we got really good jobs numbers, supposedly. I will tell you, those really good jobs numbers, as I told you during Biden's administration, are completely fabricated crap. BLS jobs numbers are absolute, utter trash. They are made up political propaganda tools. I will die on this hill. I will get very passionate about this. And I was passionate about it in the last administration. I'm passionate about it in this administration because they use the Bureau of Labor Statistics to very discreetly control, and then they do revisions later, and no one pays attention to revisions. All right. Trump, notably, once he was in office, fired the old head of the BLS and got raked over the coals by the financial news media, the propaganda tools that they are, just because they are propaganda tools, an extension of any of the news media. But it was, oh, how dare, it was because she was a woman. It was because of this. It was because of that, and blah, blah, blah. No, it was because she cooked the data and she allowed the data to get cooked under her watch. We currently are watching the data get cooked because it just so happens that every time markets are in a turbulent or timid space and the economy's not looking good, and it just so happens we're also in an election year with midterm election cycles, and it just so happens that that coincided right with a bombshell event occurring in the state of Kentucky, my home state now, where we saw a tremendous amount of highly politically aligned and non-domestically aligned. I'm going to try to be as correct as I can about this. I don't want to ruffle too many feathers, but we saw the most expensive primary in history take place, where more money was pushed behind getting rid of a candidate simply because he is in opposition to what is currently the, let's say, favored approach. But there has been a lot of attention paid to that. And for that reason, having good jobs numbers makes the economy look good. And all of a sudden, people are like, oh, AI is not taking everybody's job. Oh, all these things that certain parties stand to lose if these stories really take off, they get pushed under the rug. So whether dark money pools and political action committees, committed what could basically be the equivalent of treason in the state of Kentucky, whether they did or didn't, I don't know. But the point is that story under the rug. Whether or not there is actually a real peace deal for the 35th time with Iran or not, that goes under the rug, right? All this, jobs are good. Well, jobs are good, but then it's okay, but now we're going to get a rate hike. No, we're not going to get a rate hike. I can almost promise you, and I am rarely one to look at the future instead of looking at the weight of the evidence, but I would tell you that in all likelihood, we are not going to get a rate hike. We're probably not going to get a rate cut this meeting. We probably will get a rate cut at the next quarterly meeting, which will come right, coincidentally, right in time for election season, right at the peak of election season, when the most angst is going on, and when, again, notably, and this is why I bring up Kentucky, the Kentucky election, and there's one in Georgia that was also an interesting one that coincided, but the Kentucky primary was a critical piece of a puzzle to ensure that the current House, and then of course there's also a senatorial condition that is being addressed, aligns very, very highly with what was once MAGA. Now you might call it MIGA. Now you might call it the greatest ally coalition. I don't know. Point being, though, is there are clear and defined uh, co-interests going into the election season to align with what the current agenda is. Whatever you want to look at it and see what you want to see there. Okay, because you can see all kinds of things in it, but to stimulate the economy at the election time, it moves voters way more than anything else. So we might see that markets kind of start to see a fall off as tensions arise, not knowing what the political atmosphere is going to look like, what kind of regulatory or policy making future do we have. I would argue it's probably not going to be very different, regardless of who gets elected. That's my take on things. But point being, though, is right there in that next quarterly Fed meeting, we probably will get a slight cut. and that will stimulate the market. It will also create inflation. And then in the fourth quarter, we'll be able to actually raise rates to tamp down the inflationary pressures, all while presumably, if all things go to plan, the election goes as this current broader administration reach, right? The octopus, the tentacles are kind of all over the place, but they get what they want. And for that reason, there's going to be a lot of supporters of that belief, of that agenda, and a lot of them not being necessarily the individual but the corporate parties and high powered players, the oligarchical class, if you will. They're going to be happy that they know what direction things are going in, and then all of a sudden the market is actually going to be able to weather the storm of a rate hike, which typically a rate hike is going to suppress markets. It'll probably be a neutral market as we go into the next year. A lot of that is circumstantial. A lot of that is circumspect. I am kind of looking at what the weight of the evidence suggests we are on track for. I will change my mind if I see something different. But for that reason, I do not see a rate hike next week. I am actually remaining fairly bullish on the markets broadly, but not necessarily on the semiconductor, domestic, whatever market. There's implications for emerging markets because right now emerging markets have become very, very significantly overweighted to Taiwan, South Korea. Um, they do, I think, long term they're in good position, but there's probably going to be some additional volatility there. And I think that we're on track to see some unique market behaviors as we go through the summer months. For those that care, I know this has been a bit, it's a 45-minute long video, but I'm going to quickly size me down and bring up a couple quick charts just to showcase what IPOs oftentimes will look like in the market. I'm going to bring up this particular chart here. To show you. The blue line is the Russell 1000. So this is the aggregate index of the 1,000 largest US companies. So that gives you a good bellwether of what the market is doing, because again, the US market is very dominant globally. But this is when Alibaba went public. So we see here the pricing, the opening pricing was, and I'm going to take myself off the screen here, at about $100, right? 99.70, give or take. Or 92.70, excuse me, is where it opened, went up to 99.70, but then we saw it come all the way down in here to, roughly speaking, $83 before it saw a big ascent. But this big sell-off, this is kind of holding the bag, right? That's the symptomatic thing that often occurs. We'll use a different example of GM when GM went public again, or went public, right? This is post 2008. The government bailed them out, blah, 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 blah. They come back to the market. Okay, we get a situation where we saw this decline before a spike, before a really significant decline. However, in this case, that Russell 1000, right? We saw the 2011, the double dip recession talks. That was what was going on at that time. So this was partly market driven, right? But it was also continued, whereas GM took a long time to kind of catch back up with the Russell 1000. In fact, it took so long that it still hasn't happened yet, right? So we could see here that was a case where the IPO, you didn't want to get in on that early on. I'll use something a little bit more recent, which is CRWV, CoreWeave. This was a fairly large IPO recently, going back to 2025. We can see here the big run up and then the crash down back to about where it listed. Okay, but then the market pricing really started to show. And then, of course, we saw a big decline post 2025, and it's settling in. And now here we are. We're priced, what is that? About $95 when it initially issued, somewhere around $39 to $40. So you're still doing quite well, right? You're up 143% over this time frame. But boy, that's a volatile ride. And then I think this is actually the best proxy because this was the most talked about IPO in recent history. And that is what was Facebook, what is now Meta Platforms. This one's famous, right? Because if I really zoom it back to the experience of those initial investors, right? They started here at the initial offering, which actually priced, and I remember because we had allocations in my office at the time, it was about $45, give or take 42, 45. And then it just cratered right off the bat. Big selling. Market didn't understand it, right? That was the talk by those proponents of it. And for those of us that really were agnostic to it. Um, it was just kind of funny to watch. I didn't like watching people lose money. It was funny because there was all these diehards that are like, hey, it's the greatest thing in the world. It's the great look. It's not the greatest time to own it, even if it is the greatest thing in the world. We ended up hitting a low around $17. I mean that's a deep cut, right? You go from 40 45 to 17, taking 50% off. Now, excuses I take that. Now, fast forward, and of course, yes, Facebook has done quite well comparatively to that Russell 1000. But it's been a volatile ride along the way with again 2020, 2021 to 2022 being another major sell-off in Facebook, and then the name change and everything else. So, what'll happen with the Tesla, the SpaceX IPO is anybody's guess. I could presume we'll see a run up, we'll see a decline, we'll see market pricing, market price discovery, and then eventually we will find ourselves with a good understanding of what appropriate pricing looks like. And then we'll be able to see whether or not it becomes a necessary part of a portfolio. So, with that being said, I hope this has been a helpful take on everything going on. If you have any questions, if you want to talk about it specifically, let's talk about it. Otherwise, give me a call if you have any other questions. And if you see something that catches your attention and you want my take on it, I'm more than happy to share. Have a great day, have an enjoyable week, and enjoy the summer. All right, bye-bye.